Currently, the interplay between the financial markets, interest rates, and the economy is indeed a bit like a Rube Goldberg machine in action. It's highly complicated and delicate, and the slightest misstep or miscalculation could throw everything off course. So the question becomes, with nearly a flat yield curve, is the machine close to stalling already? It's that time again, time to tune out the hype and focus on the facts. Facts that matter to you, the income generation. Let's get started. Get ready to separate reality from myth.
With us, David Scranton.
David Scranton.
David Scranton.
David Scranton.
But David Scranton says, hey, not so fast.
How does it affect the markets? How does it affect the economy? Thanks to efficiencies and new technology and a staff of veteran analysts and portfolio managers, Sound Income Strategies strives to set new standards and bring institutional style investing to your portfolio. I'm David Scranton. You know, 2018 was a year of major chaos and uncertainty for the global economy and for the financial markets in general. We saw record volatility, we saw 4 short-term interest rate hikes by the Federal Reserve, and by the end of the year, an increasingly flat yield curve. Nothing has changed much in the first few weeks of January, except that the yield curve has gotten a little flatter, and even more new issues have emerged to rattle Wall Street. We're going to break it all down today by focusing on several key factors, including exactly what a flat yield curve could mean for both bond and stock markets individually, as well as for the economy overall. And joining us today will be Peter Cardillo, as well as Sound Income Strategies representative Michael Stewart. But first, let's talk a bit about the yield curve and why it's so incredibly important to the smooth operation of the market machinery. As you might recall, the terms flat and inverted yield curve made a lot of headlines back in December when yields on the 2-year Treasury rate rose higher than yields on the 5-year Treasury rate. This created a partially inverted yield curve. The term refers in part to the rare occasion when short-term U.S. Treasury bonds actually earn more interest than long-term bonds. It's significant. Why? Because many economists consider it to be a major warning sign of a coming recession. Inverted yield curves occurred right before the Great Recession of 2007 and also before the recession that began in 2000 going into 2002, as well as those back in 1991 and 1981. But as I've explained on previous shows, there's also a way in which the yield curve becomes completely flat. And the reality is that we're dangerously close to that occurring right now. It happens when long-term interest rates overall sink to the same level or lower levels than short-term rates. As you know, the Federal Reserve is in charge of setting short-term rates, while long-term rates fluctuate naturally based upon market forces. That is, namely, the buying and selling of bonds. As noted, the Federal Reserve approved 4 rate hikes in 2018, including one in December, which then brought the current Fed funds rate up to a full 2.5%. As you probably also know, President Trump has been sharply critical of the Fed's moves, blaming their rate hikes for much of the extreme volatility the stock market experienced throughout 2018. And there's probably some truth to that, in part. Why? Because with each successive rate hike, the Fed has moved closer and closer and closer to creating a completely flat yield curve. Consider for a moment that the yield on the 10-year Treasury throughout 2019 averaged so far 2.69%. And consider that on January 3rd, it dropped as low as 2.56%, just a fraction of a percentage higher than the new Fed funds rate. That's exactly how close we've gotten to a completely flat yield curve. And we're not even 1 month into the year yet. Now, while many economists have been expecting long-term rates to break above 3.5% or even higher for some time now, I've been saying just the opposite. In fact, I've been forecasting that long-term rates will continue hitting a strong resistance level at or below 3.25%. And this is for a number of reasons. One is the suppressing influence of quantitative easing efforts abroad, Europe and other parts of the world. Another is the fact that I believe more and more baby boomers nearing retirement will continue reducing their stock market risk, as they should, and turning toward the relative safety and income generation of the bond market, keeping bond values up and therefore keeping interest rates down. That's something that we'll talk about more later in the show. Now, if you saw my market forecast show just a few weeks ago, you know that one of my predictions for 2019 is that the Fed will not be able to achieve its goal of instituting 3 more short-term interest rate hikes this year. In fact, I'm forecasting that they'll be lucky if they'll be able to approve just 1 more rate hike throughout 2019. And this resistance level on long-term rates is the main reason. We're already so close to a fully flattened yield curve that even another minuscule increase in short-term rates could greatly increase the risk. As I've explained before, when the difference between long-term and short-term rates is minuscule or non-existent, banks and lending institutions have little financial incentive to approve loans. Borrowing comes to almost a complete stop and creates a ripple effect throughout the economy. And with many experts already forecasting a major slowdown in economic growth this year, a flat yield curve would almost certainly make matters much worse. But even if it doesn't happen, the mere risk could have major consequences. And we'll talk more about that also later in the show, as well as about how a flat or nearly flat yield curve could impact the bond market specifically. Right now, it's time to welcome Peter Cardillo. He's currently the chief market economist at Spartan Capital Securities. He has more than 50 years of comprehensive professional experience in financial services. He started at the age of 12. Peter is also a frequent commentator on media outlets including CNBC World, Bloomberg, the New York Times, and the Wall Street Journal. Peter, thanks for joining us today.
My pleasure. Thank you for having me.
So, in a recent article that appeared in theeconomictimes.com, you mentioned that the bond market is sending a message of fear, that the economy is slowing down. What do you mean by that, and why do you say that?
Well, there's no question that the economy is slowing down. We have some economic indicators that are still pretty good, but there are other indicators that are pointing to a slowdown. In fact, just today, we got the leading indicators that showed a decline. They were down 0.1%. I want to also point out that the lagging indicator was actually up by a 0.5%. But that's a good indication that the economy is slowing. Then if we look to the housing market, you know, for a while there we had some real mixed signals, but now it seems that the trend in the housing market is definitely to the downward side. And then, of course, you know, we have some strong indicators. For instance, today we got the jobless claims number out, and certainly they are very strong. They continue to indicate a very tight labor market.
Sure.
They're at a 49-year low. Okay. They haven't been this low if you take the 4-week average since 1969.
So do you agree with my statement then that the bond market tends to be smarter than the stock market in many ways, that the stock market seem to have the blindfolds on and be marching north, whereas the bond market is putting the brakes on?
Well, I think you're right in saying that the bond market, you know, has more sophistication than the stock market. That's not to say that the stock market is not a good barometer. Absolutely not. But the stock market, the bond market usually gets it right. But what is the bond market fearful? And what are investors really fearful? They're fearful of the trade war lingering on. And if that happens, you know, we're on the path to isolation. And isolation is never good. Isolation, you know, if you go back in history,
sure.
Back in the 1930s, you know what happened.
Right.
And so that's the greatest fear.
How about the Federal Reserve? I mean, a lot of the bond market seems to be concerned that the Federal Reserve is going to keep hiking short-term rates, regardless of what the bond market does with long-term yields. Do you think that rate's up there with concerns about trade war with China, or do you think China still takes precedent over that?
I think China takes precedent over that. The Fed is doing what they should be doing, or at least what they should have been doing, and obviously they're on hold. I believe that they'll probably stay on hold for at least two more quarters, unless the economy weakens so much, then the tightening cycle is probably over. But I'm not suggesting that it's over just yet, because the economy is still showing signs of strength. There are pockets of strength, and those pockets of strength are obviously emanating from the consumer. But that can only go so far. And
Sure.
what the Fed has done, I think, when you have such a tight labor market that we have, they're just taking extra precautionary measures. And rates are, I don't want to say they're at normality, but they're pretty close to it, and the Fed has basically indicated that. So I'm not blaming the Fed.
Really why?
I'm blaming the trade war.
But is that really why they're raising rates? But a lot of people believe that part of the reason that the unemployment rate is so low is because the unemployment rate they always publish really doesn't account for all the long-term unemployed people / discouraged workers, et cetera. That the real reason the Fed's raising rates is because they want more ammunition left over for the next time there's a recession. But isn't there a fear that they could create that recession in so doing?
Look, interest rates were at zero. They're just now creeping up towards normality, or maybe they're at normality. I don't know. That's debatable.
Right.
But when you have an economy that was growing, and I say was growing, at 3% plus, you can't have the Fed funds rate where they were. You need the Fed funds rate to be just slightly above or slightly under. And so, again, I think that they did the right thing. Now, there are so many geopolitical uncertainties that that is what I think is really adding to the fear factor.
And in some ways,
that fear factor
China is one of those. We need to leave it there for this segment for just a minute, but stay with us, Peter. And you stay with us too. We'll be right back here with more on the Income Generation. I'm David Scranton.
For behind-the-scenes photos, retirement planning tips, and upcoming giveaways, follow the Income Generation Show on Facebook. And don't forget to subscribe to our YouTube channel to watch video clips, guest interviews, and to catch up on past episodes.
Read David J. Scranton's groundbreaking new book, Return on Principle, 7 Core Values to Help Protect Your Money in Good Times and Bad. Discover practical solutions to the financial challenges facing today's generation of retirees and near retirees. David Scranton's approach to financial planning is a holistic system designed for maximum protection, strategic growth, and reliable income regardless of market conditions. Available now.
So what exactly might a flat or nearly flat yield curve or even the ongoing threat of one mean for bond investors specifically? Well, although treasuries are generally regarded as safer investments than stocks, watching their interest rates bounce and flatten in confusing ways can be a recipe for concern. And that's especially true if your financial strategy hasn't yet aligned with your retirement income needs and your retirement income goals. Now, if it has, then your diversified portfolio of individual bonds is hopefully being actively managed in a way that keeps you on track to meet your income goals regardless of market conditions. And we'll discuss this a bit later in the show. But with that in mind, let's consider some of those possible conditions for the bond market overall, depending upon what happens with interest rates and the yield curve this year. I've already shared my own forecast, which calls for several forces to continue creating a strong resistance level for long-term interest rates right around at 3.25%. Broadly speaking, this is good for bond investors. Why? Because the well-known inverse relationship between bond values and interest rates. You see, when rates rise, interest rates that is, bond values tend to drop. And when interest rates go down, bond values tend to increase. Now, naturally, there are a lot of other factors that affect bond values. But all in all, the resistance level that's frustrating the Fed and keeping the yield curve close to flat is a plus for bond investors, even if it's potentially bad for the economy or potentially bad for the stock market. In fact, another one of the forces behind the resistance level has been a flight to quality in the bond market due to the record levels of stock market volatility that we've seen at the end of 2018. Investors who fled securities in the midst of some of the largest intraday point swings in stock market history last year fled into bonds. If a recession does hit this year, or even if the fear of one continues to escalate, I would expect this flight to quality to continue. This is another factor that could bode well for income-based investors using strategies built largely around bonds and bond-like instruments. Now, what's more, the slight fluctuations in long-term rates between about 2.5% and 3.25% can actually be good for bondholders whose portfolios are actively managed. Those fluctuations give the manager the chance to upgrade for higher yields and capital gain opportunities. It's also worth noting that this resistance level for long-term interest rates, and I believe it exists and will exist in spite of the Fed's active efforts to force rates upward. Last year, the Fed began the so-called process of unwinding quantitative easing. This involves selling back the trillions of dollars in U.S. Treasuries that it purchased as part of the program called quantitative easing. One of the goals has been to try to manipulate long-term interest rates upward. How? By flooding the market with all these bonds. The simple law of supply and demand says that should have driven bond prices down and thus interest rates back up. But like so many other aspects of the Fed's experimental policies these past 10 years, it really hasn't worked. And thus, the Fed's yield curve dilemma continues, and I believe will continue for the foreseeable future. But just for the sake of argument, let's say that it doesn't continue. Let's say long-term interest rates do rise notably this year, perhaps cracking even above 3.5%. Well, again, it's almost a moot point for income-based investors with actively managed portfolios. Those portfolios based upon bonds and bond-like strategies. And here are two reasons why. One, active management is designed to achieve competitive rates of return, even in a rising interest rate environment. And number two, with individual bonds, any temporary drop in value is really just that. It's temporary. It's a paper loss. Because the return of your principal amount at some point in the future is ultimately guaranteed, provided that you hold the bond to maturity, and of course, provided there are no defaults. Now, keep in mind, though, that these factors do not apply to bond mutual funds. Bond mutual funds are much more vulnerable to stock market volatility, and they simply don't come with contractual guarantees. They don't come with a guaranteed interest rate, nor a guaranteed repayment of principal at some point in the future. We'll talk more about that, as well as some other potential impacts of a flat yield curve, or just the fear of one, a bit later in the show. And now it's time to welcome back Peter Cardillo, Chief Market Economist at Spartan Capital Securities. Peter, thanks for sticking around. Right before the break, you mentioned really the concern about geopolitical type pressures. But I guess what concerns me when I look at long-term interest rates, if you really have GDP growth of over 3%, you have unemployment that low, long-term rates should be higher to allow short-term rates to come up. So why, in your opinion, are long-term rates just staying stubbornly low?
You know, that's a $64,000 question. I don't know how to answer that question. And I can only think that because the market feels that the growth rate is not sustainable. If the market felt that the 3% plus growth was sustainable, I would imagine that you would see those long-term rates shoot much higher, but they haven't been. You're right about that.
So what do you see happening now through 2019? If growth rates slowing, do you see us actually seeing recession in 19? Do you see us seeing recession perhaps closer to 2020? I know it's a crystal ball question. I hate to put you on the spot, but hey, That's what I get paid to do here on television,
No,
put people on the spot. So what's your best guess?
That's quite all right. I have an opinion on that. No, I think we're going to escape recession this year. 2020, I think we get very close. In my opinion, there's probably a 70-80% chance of recession in 2020. Now, that all could change if we get a trade deal. But if the trade talks continue and there is no concession on either side, then where I would say recession 2020 is not far-fetched. And that's simply because of the fact that what we're going to see here is consumers begin to pull back. And let me throw in another factor here. The government shutdown is not helping.
No, not at all.
There's a good possibility. There's a real good possibility that maybe the White House economist, who just yesterday said that we could be facing zero growth this quarter. I don't share that view, but if the shutdown continues for another 4 or 5 weeks, that's a real possibility.
I know.
And so to make up that time, that lost growth time, you're going to have some powerful ingredient, and that powerful ingredient is to make a trade deal, whether
Peter,
it's what the administration is looking
Peter,
for or not.
So if it's 70 to 80% recession in 2020, and I happen to agree, in 20 seconds we have left, what does that mean for the stock market this year, and what do you want investors to know? 20 seconds.
I think it's going to be a bumpy ride and a very selective stock market.
Very selective stock market. So in other words, you're not out there buying indices or mutual funds. You're better off stock picking the right industries. I couldn't agree more. Peter, it's been my pleasure having you on the show. We'd love to have you back. Thank you. And you stay with us. We'll be right back here with more on The Income Generation. You're watching The Income Generation. I'm David Scranton.
For behind-the-scenes photos, retirement planning tips, and upcoming giveaways, follow The Income Generation Show on Facebook. And don't forget to subscribe to our YouTube channel to watch video clips, guest interviews, and to catch up on past episodes. David J. Scranton, Amazon bestselling author, money manager, and national TV host, is on a mission to educate baby boomers about the need to shift from growth to income. If you're at or near retirement, focusing on income over growth can make all the difference in the quality of your retirement. Each week, David educates America on his Newsmax TV show, The Income Generation, where he provides special reports and more to teach baby boomers about the income model. Call now for a free copy of David's latest book. Go to soundincomestrategies.com/income to find out more.
If you're near or in retirement, head over to theincomegeneration.com and download your special report written specifically for the needs of the income generation. Again, those born before 1966. I'm David Scranton, and you've been watching The Income Generation. Now, as you probably recall, Wall Street ended 2018 with its worst December since the Great Depression. All the major indices finished the year with losses. And if you saw my 2019 market forecast show just a few weeks ago, you know that I'm predicting another negative year for the stock market, in addition to a major slowdown in growth and the possibility of actually going into a recession before the end of the year. So could it be the next major drop of what I believe to be our current long-term secular bear market cycle, ultimately dropping as much as 40 to 70%? Well, yeah, it could be. But either way, I do believe the stock market will again finish the year lower than it began 2019. Now that's important to consider if you're retired or close to retirement and you haven't yet made the shift from growth-based investments to income-based investments. Why? Because if you're still invested mainly for growth, any losses you incur this year are more likely to be permanent losses. And there's two reasons for this. First, as I've explained before, is the fact that total return is the sum of both growth and income, with growth coming in the form of capital appreciation and income coming in the form of interest and dividends. If you're invested primarily in stocks or bond mutual funds, then you're invested heavily for growth, and you're depending upon or hoping for capital appreciation. The problem with that, though, is growth sometimes turns to shrinkage when the stock market drops. And when that happens, your portfolio shrinks too, but for real. And number two, stocks and mutual funds are not contractual investments. They don't come with two important guarantees you get with individual bonds and bond-like instruments. Again, as I said before, that is income at a fixed rate regardless of market conditions, and the return of your principal if you hold the bond to maturity, and of course there are no defaults. Again, that's why the question of whether interest rates will hold at their current resistance level, as I believe they will, or notch higher, and why that question is largely a moot point for many income-based investors. Regardless of whether their monthly statement goes up or down, it simply should not affect their income. By the same token, they can worry a lot less about things like the potential impacts of a flat or nearly flat yield curve, the possibility of recession, or the threat of another major stock market crash. Those issues are a lot more concerning for investors who've not yet made the shift from growth-based financial strategies to those based upon income. But if you are one of those investors, then the question becomes, just how concerned should you be? After all, let's face it, I don't have a crystal ball. No one does. My forecast could be wrong. The economy and the stock market could both grow again this year. Anything's possible. But the question that I always ask is it probable? And to answer that, let's jump back to December for a moment and analyze what happened when the Fed approved that last short-term rate hike in the midst of record stock market volatility. There's an old saying that the bond market is in many ways, as they say, smarter than the stock market. And I think we saw a good example of that in December. See, before then, each time the Fed announced it was planning to raise short-term interest rates, longer-term bonds would sell off, therefore allowing prices to drop and longer-term yields to increase. In essence, giving the Fed some room to raise rates without flattening the yield curve. But in December, it was as if the bond market said, enough is enough. And this time bond yields, long-term bond yields, didn't rise to make room for the Fed's next short-term interest rate hike. In other words, the bond market was basically saying, we know we're not going to get the level of economic growth needed to sustain higher interest rates. So let's just pump the brakes. Ironically, that's an opinion shared not only by most economic forecasters, but now by the Federal Reserve itself, which has forecast GDP growth falling back below 2% by the year 2020. Most analysts and big investors realize that corporations have already ingested all the profits from the Trump administration's corporate tax cut. At 15% tax cut, that cut was essentially the biggest boost provided by the new tax plan anywhere. But that effect isn't likely to last, which means future growth is more dependent upon individual tax cuts now, which were only a reduction of about 3 or 4% on average. Now, while that gives consumers a little extra spending money, it's probably not nearly enough to sustain GDP growth rates of over 3 or 4% like we saw at points during 2018. In looking at these details, it's important to understand that recessions and major market corrections can have different causes and symptoms. And what we're seeing now are a lot of symptoms that have the potential to actually become causes. We'll be talking more about this in just a moment. Right now it's time to welcome Sound Income Strategies representative, as well as a good friend of ours, Michael Stewart. Michael has nearly 20 years of experience in the financial services industry. He's founder of Crystal Lake Tax and Financial Group in Crystal Lake, Illinois. Mike specializes in serving the tax and financial planning needs of clients that are in or near retirement age. That's why he's the perfect guest for today's show. He's a highly sought-after speaker, co-author of the book entitled Purpose-Based Investing, 9 Lessons to Rescue Your Retirement from Wall Street. And he's also the co-host of the Retirement Matters podcast. Mike, welcome to the show.
Thanks for having me, Dave.
So, we were just talking a couple days ago over the phone about the economy and so on. So why don't you share some of your basic thoughts about what you see in the economy now that we're in 2019 with our income generation viewers?
As we basically are early on into 2019, I do have some reservations and concerns about what's going on in the economy. Primarily, you take a look at where the yield curve is, it's relatively flat. We have a lot of indicators kind of flashing warnings out there, whether it's transports, small caps, even taking a look at slowing earnings in the US as well as internationally, heading towards a recession on a global basis as well.
So earlier in the show, as you heard, we talked about the yield curve, how sometimes the yield curve can actually be a symptom of lack of growth and of a recession, but sometimes it causes a recession because the yield curve flattens because of external forces, such as the residual effects of quantitative easing here and abroad. And then as a result, that symptom actually causes the recession because banks shut down lending. In this case, what do you think the flat curve is? Do you think it's the symptom, or do you think it's going to actually cause the next recession?
I think with the Fed's involvement with some of the things they're doing on quantitative tightening, it actually could be the cause of going into recession, really in two different areas. The first one is the Fed, although publicly recently they've said that they're going to be data dependent on how they raise interest rates, and they call for 2 rate hikes this year, although the market's pricing in none. So they could raise this into an inverted yield curve, which would speed up our entry into a recession with the slowdown in lending. The second thing is with them rolling off nearly $50 billion every single month, kind of unwinding their balance sheet, that alone, if supply exceeds demand, that alone might push rates a little bit higher and also invert the curve. So there's definitely some concerns there.
30 seconds we have left in this segment, though. Why hasn't that pushed long-term rates up significantly yet? They've been rolling this 50 billion off every single month. Why hasn't it had that effect so far? It's supposed to, right?
Yeah, it should have. And even just the increase in interest rates, you would expect at longer term rates, if we truly were in a robust, healthy economy, then long-term interest rates should be going up. The dumping of all these extra securities into the market at about 50 billion a month, should have also, in addition to regular rate hikes, pushed rates up. So I think it's really the credit markets saying that we don't believe the Fed and we don't believe a lot of the backward-looking economic numbers.
The old story, the bond market's smarter than the stock market. Michael, stay with us. We'll be right back with more on the income generation.
David J. Scranton, Amazon bestselling author, money manager, and national TV host, is on a mission to educate baby boomers about the need to shift from growth to income. If you're at or near retirement, focusing on income over growth can make all the difference in the quality of your retirement. Each week, David educates America on his Newsmax TV show, The Income Generation, where he provides special reports and more to teach baby boomers about the income model. Call now for a free copy of David's latest book. Go to soundincomestrategies.com/income to find out more.
If you're near or in retirement, head over to theincomegeneration.com and download your special report written specifically for the needs of the income generation. Again, those born before 1966. I'm David Scranton, and you've been watching The Income Generation. Again, recessions and major market drops have numerous causes as well as numerous symptoms. And what we're seeing today are a lot of symptoms with the potential to become causes. That's just how economics and the financial markets tend to work. Sometimes the tail wags the dog until the dog starts wagging the tail again. For example, sometimes the bond market, which, remember, can be smarter than the stock market, doesn't think the economy has enough long-term growth potential, so long-term interest rates come down and the yield curve gets flat. That's a symptom of a possible recession. But sometimes the yield curve becomes flat because other influences don't allow long-term interest rates to increase and/or the Federal Reserve raises short-term rates too quickly. This is when that symptom, that flat yield curve, that symptom can quickly become the cause. As I noted earlier, banks don't like to lend with a flat yield curve because there's less profit in it during that time. That can hit businesses in the housing market hard, and it can create a domino effect that leads to an actual recession. This same idea holds true for the stock market. Sometimes the stock market drops because a recession occurs, and the sell-off is a symptom of the recession. But sometimes a volatile or tumbling stock market can be based purely on fear. Fears of stalling growth or fears of a flattening yield curve, for example, like we're seeing now. And it could end up actually causing a recession. How does that happen? Well, one way is that fear-fueled market creates what I call the reverse wealth effect. In other words, investors see their 401ks and investment accounts shrinking. And regardless of whether they have more disposable income thanks to a tax cut or thanks to a wage increase, they simply feel less wealthy. They feel a little bit less affluent. And as a result, they cut way back on spending. Therefore, the economy eventually shrinks into a recession. And let's not forget that beyond the flattening yield curve, there are many other factors pointing towards stalling growth and a possible recession this year. Not to mention all the other unstable geopolitical factors, especially some of those that Peter had spoken about a moment ago, keeping Wall Street on edge. Those include, of course, the ongoing trade war with China, economic instability in Europe and Asia, mounting federal debt, and most recently the partial government shutdown, Brexit, etc., etc. But covering the shutdown for just a minute, it is no doubt just a preview of how rocky things can be in Washington and are likely to be, and across the country this year, especially now that the Democrats control the House. The point is, I believe there are enough symptoms and potential causes of a major stock market downturn this year that it's irrelevant whether the dog wags the tail or the tail wags the dog. Either way, investors at or near retirement who have not yet shifted their strategic focus from growth to income might just want to ask themselves the following question. Are my own goals in jeopardy if worse comes to worse for the stock market this year? Now it's time to welcome back my good friend and Sound Income Strategies cohort, Michael Stewart. So Michael, let's pivot to the stock market then for a moment. Why has the stock market been able to shake off a lot of the bad news, it seems, even when we almost got down into bear market territory? Now we bounced right back and we're starting to get somewhat near previous highs again. Why does it seem like the stock market isn't agreeing with the bond market?
I think it's a function of kind of a short-term memory. If you think a lot of individuals for the past 9 years, with the exception of right in 2018, the market's seemingly only gone up. And I think it's short memories of investors that markets really go both directions. They go up and down. So, for the last 5 or 6 years, you've been rewarded for buying on the dip. So people have been conditioned to go in and buy every time the market sells off. And I think we've seen a fundamental change start. We were in some oversold conditions just coming off of post-Christmas, but I think we're starting to run into some headwinds currently.
And this is kind of common, isn't it? I mean, you remember back, in 2007, it took till November of 2007 for the markets to start to react to the subprime crisis, even though you and I knew that it was there in February or March. It took maybe an 8-month delay. So you think maybe that's what's happening now, is the news is out there and the market's just trying to hope and grasp for a higher level, and then maybe more third quarter of the year we'll actually see a slide? Is that possible? What are your thoughts?
I think it's absolutely possible. And, we're counseling with some clients lately is we'd rather be a little bit early, kind of seeing some of the warning signs about recession down the road, whether that's late 2019 or 2020. And we'd rather be a little bit early in position to not be harmed by any kind of economic downturn that's forthcoming and actually be able to use it as an opportunity rather than be harmed by it.
In a nutshell, it sounds like you think, and I don't want to put words in your mouth, but it sounds like you think that 2019 will probably end the year with the stock market somewhat lower than it entered the year. Is that your thought?
It would not surprise me at all. Between the Fed's movements and then just some of the ongoing global weakness that we're seeing, it's all going to come to a head relatively soon.
And the longer we have a trade war and the longer we have a government shutdown, the greater the probability. So Michael, stick around with us, if you will, for one more segment. And you stick around with us too. We have many more words of wisdom here from my good friend Michael Stewart. You're watching The Income Generation on Newsmax, and I'm David Scranton. We'll be right back. Welcome back to The Income Generation. I'm David Scranton, and I'm here with a good friend and Sound Income Strategies cohort, Michael Stewart. So Michael, right before the break, you agreed that there's a high likelihood that the market ends 2019, the stock market that is, lower than it entered 2019. I think it's possible that this could be that third major drop that you and I talk about frequently, that historically almost has to occur in any long-term secular bear market cycle, a drop of at least 40%. What are your thoughts on that? Is this it?
Yeah, if you look at stock market history, it's got to be coming. So, we've gone nearly a decade. I mean, if you just look at just not only stock market history, but the economy itself, typically every 4 to 6 years, we should have a recession or a bear market. And we're 9+ years in. So we're long in the tooth regardless of this. So, but once again, if you look at stock market history, it says that a third drop's coming, and we're a lot closer than we were a few years ago.
So now let's bring it down to grassroots. What I love about you is you've got your boots on, you're in the field talking to clients like I am every single day. You're not some economist up in an ivory tower talking theory. So what do our income generation members need to know? What do they need to hear from you, those age 50 and over, with economic conditions the way they are today?
Yeah, really, I would kind of look at 3 different things, really. The first thing would be, much like we had talked about in a prior segment, that we're 9 years into a recovery. So whether we think this is the next big drop or just going to lead into a normal recessionary bear market type of approach, it's better to be proactive and be prepared, and kind of capture some of those gains that we've been fortunate to get the last 9 years. The second thing is really a shift, especially for those in their mid-50s to early to mid-60s, is really focused more from that accumulation mindset that the stock market's the only place to get return, more into kind of a distribution and income mindset, to where you can get a little bit more sustainable, predictable yield and gains on your returns, rather than essentially only hoping that the market goes up as your only strategy going into retirement. And the last thing, probably the third thing that's critically important, is really having a great grasp on the difference between your risk tolerance and your risk capacity. So risk tolerance is, yeah, I understand the market fluctuates. Risk capacity is, now that you're in your 50s or 60s and you've amassed the largest part of your net worth and retirement savings, what do you have capacity for losses? Because those losses at the late stage of the game here are going to be more impactful than the potential gains that you might get on a go-forward basis. So I would kind of put my arm around all 3 of those and just make sure on a risk-adjusted basis that I've been proactive as far as protecting my assets as I get closer to retirement.
A man after my own heart. No wonder why you and I have such good conversations all the time. Most important question, 10 seconds. You ready? Who's going to win the Super Bowl?
Patriots.
Patriots, all right. Go Patriots. You just made enemies of probably 3/4 of our viewers. Michael, thanks so much for being on the show today. Really appreciate you being here.
Thanks for having me, Dave.
And you stay with us. We'll be right back with more on the income generation. I'm David Scranton. Stay with us. I'd like to thank all of our guests for joining us for another episode of the Income Generation. Of course, most importantly, I'd like to thank you, our new and returning viewers. At the top of the show, I liken the economy in the financial markets to a Rube Goldberg device that could be stalled by the slightest bump or miscalculation. I hope it's clear from today's show that there are currently an incredibly large number of ways in which those bumps or miscalculations might occur, a wide variety of symptoms, I guess you'd say, in other words, with the potential to become causes of a new recession, another year of losses for the stock market, and potentially the third major sustained market correction since the turn of the century. I hope it's also clear from today's show that you have a lot of control over the degree to which those issues, or even just the threat of them, can impact your retirement goals. If you're still invested for growth and capital appreciation, yes, they could have a major impact. You could end up having to downgrade your goals or even delay retirement. If, on the other hand, you've made the shift already from growth-based investment strategies to those based upon income, in that case, the impact could be far less substantial. What's more, even if none of the symptoms do become causes this year, even if the economic machine doesn't stall out, at least you'll have spent a lot less time worrying about your money than you probably would have otherwise. In fact, I believe that's a major part of what income-based investing is intended to provide. That is peace of mind, which I believe is an almost priceless commodity in today's day and age. It's also worth noting that according to a recent Bloomberg article, Even a number of major financial firms, normally very Wall Street oriented and stock market friendly, have recently touted income-based financial strategies as viable shelters from the increasing storminess of the stock market. These are firms like HSBC, JP Morgan, and Wells Fargo. And as you know, I'd go further than that to say that income-based strategies are not just a smart hedge during turbulent times, but they're also a practical and dependable strategy for investors over the age of 50 at almost all times and regardless of market conditions. See, it all starts with making that shift from growth to income, first mentally and then financially, preferably with the help of an advisor who specializes in income-based strategies. Thanks for watching. If you're close to retirement and you really want to know how to protect and maximize your money, it's essential that you stay informed and up to date. And you guessed it, right here is where you can do it on the Income Generation. I'm David Scranton. Thanks again, and we'll see you next week.